This is log scale, remember. So 500 would be about where that arrow top is, that third arrow, the second arrow there. That'd be about $500. Now, that's crazy, right? Yeah, okay. Well, maybe it is. Okay.
No, I think 500 is feasible. I mean, it's definitely on the upper end of the confidence curve, of the confidence interval, but it's not out of the realm of possibilities, for sure.
It's a monetary metal, and it's undervalued, and therefore it could go ape. It's happened before, not just copper, lead. I could have thrown darts at half a dozen other markets. Yeah, gold's been doing better than the S&P for the last year, but it's really going to do better now. You just cleared a major base. So don't be shocked by what happens, but especially don't be shocked if it happens quickly. But silver miners are going to beat the gold miners. They're vastly undervalued versus the gold miners, just like silver is relative to gold. And I think the biggest slingshot effect among the miners will be in the silver miners. Anyway, then the real issue for us right now is not gold. Everything there is positive. It's been positive for us since 2016, but it's silver. And this is the same 50-year period of time. Ratio scale again. And you can see that the low end of that rectangle is like $4 or $5, it's about $4 back in 1993 and also in the mid 70s. And you shot up there in 1980 to $50, okay? It was a little bit better move than that first gold move. Gold went up 8-fold, silver went up about 10-fold during that multi-year move. Mm-hmm. With a lot of it compressed in the last 6 months of that move, where you really exploded. Silver's just broken out of the very first reality. So we have a silver gold breakout saying, no, don't buy gold, buy silver. It's going to catch up. Well, again, if I do a ratio of this, we're talking a crazy number, right?
So
Now, see
this
that
is on
range?
a log scale. If you put on a nominal scale, you see the huge the huge asymmetry.
Yeah, there was also, that goes back to 2000 high. Actually, by our measurements, we're out above those peaks there. Okay. No, excuse me. No, there was a second shelf down below there. You'll notice. See the red circle, the first ellipse you've got?
Yep.
In between, there was this other range at about 1.31%. Yeah, right there. You broke out above that, and right now you're about to break out over the next level.
Gold has broken out versus the S&P 500 after an 11-year base, signaling a major capital rotation from stocks. This is just the start of a new era for monetary metals. The primary opportunity is silver, which has now broken out against gold itself, beginning a long-delayed explosive catch-up phase. Historical market precedents like copper and lead show such breakouts can lead to parabolic, multi-100% gains in mere quarters.
The most dramatic handful of months ahead in the monetary metals, miners and silver in particular. And then later next year, you're going to get more drama out of the stock market, which is going to do what? Further infuse the Fed into pedal to the floor. Monetary excess, further degradation in the money unit, not just here, but the yen, the euro, you name it, all the Western powers. And what does that do for gold? Yep.
Jet fuel for gold. And the S&P. And what do we have here? It looks like we broke out, Michael.
Yeah, that was as of last weekend. Actually, you broke out in November. November's close. Gold relative to the S&P 500. Back in 2011, gold was, nice high levels in price and also outperforming the S&P. And then it started to collapse big time in 2013. It's when gold really started to come apart. So that says you've got an 11-year wide basing range of gold relative to the S&P where it does better, does worse, does better, does worse, but basically sideways for 11 years, either side of, let's say, 50%. You just broke out. Now, if this were a price chart and I dropped it on your table in front of you and wiped out the title so you didn't know what it was, and said, look at this chart, you'd say, gee, I got to buy that beast. Right? Okay. Yep. Fresh breakout. Well, this is a fresh relative performance asset class shift. And say, should I own the stock market or gold? None of them are beating gold now. They've all just been broken out above. And it's a start of something big. You don't break out of something like this and go up for a month or two and fail. This is just the beginning. If somebody's buying gold over the S&P, otherwise that spread wouldn't have broken out. And it's certainly not the average American investor. We know that. That's when silver said, okay, I'm unleashed versus gold and versus net price. We broke out of that same spread that gold broke out above the S&P in November. Silver broke out versus gold at the close of November. Where was silver then? I think it was the mid 50s. Okay. Already, since the close of November, we're in the month 1 of the countdown now.
Furthermore, mining stocks, especially silver miners, are completing their own breakouts poised to leverage and potentially outperform the metals. The convergence of these simultaneous signals, gold over stocks, silver over gold, and miners breaking out, creates a powerful, rare thesis. The conclusion is that the precious metals complex with silver at the forefront is on the cusp of a dramatic and potentially rapid upward move. Subscribe to Fine Metals for future updates.
Or late 2010, early 2011. Extreme compression, squished into a couple quarters where you go ape, okay? They're rare, but they're not exclusive to special markets. And that's the copper and lead charts. There you go. We put out this report in late October. At that point, silver, by the way, was $48, just to make a note. We were trying to show our subscribers, this is a history of the price chart of copper. And below, we'll look at lead in a second. But see that first low rectangle there? Mm-hmm. Actually, you could go further back. Instead of the 90s, you go back into the 70s and see the same range existed up and through mid-2005. So many decades of up, down, normal reality for copper. The red ellipse took place over a span of a couple quarters. You quadrupled the price of copper between there and about 2007, very quickly. And then look at the new range that existed since 2008. Yeah, there was a sharp drop after that. But look, the average range up there is like $7,000, $8,000 per, I guess, per metric ton. But about 4 times the average range that existed back in the 70s, 80s, 90s, 2000. So copper broke out into a new reality, and it didn't take it 3 years to get there. It took it a couple quarters. There was no headline. Okay, scroll down, now you see lead, another exciting metal. Okay, same range-bound situation, going all the way back to the 70s. Its breakout occurred in 2006-07, not the same time as the copper move. It wasn't a base metal explosion. Lead was firming up, but it didn't really go ape until that red ellipse. Okay, you went from an average price in that range in the 70s through 2007 of about, let's call it about $600, the average price. And you went up to 3,600, and most of that occurring in about 6-7 months. Again, not in sync with copper. It's its own thing. And then it dropped, but then look what happened after that. You went into a new reality. So the miners aren't weak compared to the stock market and gold. They're about to become the strongest component, stronger than gold even, in the monetary complex. And they've got, you could double in half just to get to the red line. Might not look impressive, but it would be highly impressive in terms of percentage gain. So our bias at MSA is, yes, gold market's the mama, it's leading, it's going a lot higher, but you want to be in silver and you want to be in the miners. And in particular, my emphasis is silver miners. Meanwhile, gold's blasted way above that first high, right? Okay, yep. Eightfold. Silver's the same fold over and over, okay? Then you come back down again in silver, mid-range this time, based, and now you've punched through. That last reading is $62. We're now trading at about $65. This is as of a week ago. But you finally punched out of that range a bit. Now, that's a price chart. We look primarily at momentum, and momentum has already said you're going to leave the earth here, okay? Price now sort of says, oh, me too, okay. But if you take the dimensionality of those first 2 swings, which were redundant in the case of silver, and swing it up and say, okay, I'm going to match the logarithmic scale dimension of that rectangle. We just had the last, I think, major buy signal for silver. So if you didn't get in the last several years, like when you should have, okay, and gold as well, you just had one more signal that occurred to close the last month, and that was based on our work. It said, okay, if you're not in, you got another primary level to enter. At that point, silver closed out in November at 54 bucks, I think, somewhere around 56 maybe. So, whoa, we're only $10 higher in 2.5 weeks. Okay. But that was the ride has really started now. It's really begun. Well, given that silver's already broken out of a 50-year range, why shouldn't the spread maybe do the same? Oh, whoa. We're talking 7%? Okay, forget that. Let's just focus on the 2011 peak. That was, again, a bull market peak. The spread also made a high at 3.5, well above all the highs of the prior decade or two. What if we just go to 3.5? Well, that means you could basically double and a half the price of silver relative to gold from here to there. So if gold goes up, let's say gold goes up to the old normal 8-fold high, which is what, 8,000 plus in price. It would be where it was in 2011, where it was in 1980 in terms of dimension of move. Okay, do 3.5% of 8,000. Okay, well in the couple hundreds. Okay, yeah. So the point is that major lids are coming off here, not merely price chart stuff.
That's $280.
Yeah. Oh, or what if it goes to, it was up there at 6+ twice. What if you could do that?
Well, here's what's interesting, Michael. Yeah. You compare it to the previous peaks here in the 70s.
Yeah.
You would be looking at a 330% move up in silver relative to gold. So let's say let's just say a 4x relative to gold. If gold doubles, that's a 2 times 4x, 8x from today is about $500 to, it's about what you had on your chart.
It wasn't like the floor came out instantly. No, it was a laborious process. And already gold is saying, hey, it's really just begun. The gold strength versus S&P, or you can convert it the other way, S&P weakness versus gold. It's just begun. So we suspect at MSA that probably the stock market is still going to be laboring for another couple months, possibly with a marginally higher high than we've seen the last 3 months. For example, S&P saw 6,900 3 months ago, and then again this month. It might go up and hit 7,000 to ring a nice number in, make everybody happy, and take that out. I don't think it's going anywhere on the upside of any significance. So far, it hasn't for about 3.5 months, by the way. It's been mostly lateral. And probably sometime in the second quarter, you're going to see stock market weakness that people will call weakness, whether they're upset by it. But meantime, I think it's going to be a boring, languishing effort by the stock market to hold. But meanwhile, gold is soaring compared to it.
Yeah. Are we looking at something similar to that, where the time is compressed? There's
something that happened back then in that first ellipse and the second ellipse. There's just price charts here. It wasn't the momentum of price that said something, because already at that point in time, you were well into a bull trend, as you can see. They were already going up nicely before you got into that sharp ellipse period there. When we measure silver, ounce of silver divided into an ounce of gold, we create a spread chart. A lot of people look at ratio. We do it another way. Ounce of silver into an ounce of gold. And at those points in time, prior to those 6 or so months of verticality, the spread chart of silver versus gold broke out over a nice clear ceiling. So if you were only looking at silver versus gold and plotting it as a percent,
bottom,
that's current action there.
So that takes it around 10,000 or close to 10,000.
No, it's about 8,500.
85. Okay.
Each of those first moves, the 76 bear low, which was a correction from $200 down there 100. Summer of 76, you went from that low near 100 to 850 in that first move. 8-fold move. 8 times the bear market low. Okay. Then you made a low in 2001 in price, and you multiply that times about 8, and what you got? The 2011 high. Another 8-fold move. No, on an arithmetic scale, it would be far more dramatic, but on a ratio, logarithmic scale, which how much did gold go up in multiples? 2 moves of 8-fold dimension. If you measure from the bear low in 2015, which was $1,050, it says, well up in the 8,000s. And then finally, you'll have only matched what you did twice before. Hardly a headline. I've done it before twice. It's probably going to go way beyond there. But people who think that gold is overdone, right now we're only 4-fold. So it doesn't compare to the dimensionality of the price changes 76 to 80, 2001, 2011. We're only halfway there. So that's something to pause and think about. Yeah, on an arithmetic scale, you look at the action the last 6 months or so, you say, I got to take profits. Yeah, right. Okay, fine. Do it if you want to. But meanwhile, gold just broke out above the biggest stock market in the world and says, I've just now begun to beat you. Just begun.